Hey everyone, I'm Dan and welcome to episode 3. Today I'm going to be reviewing iQSTEL. Just for those of you that are new, the purpose of my channel is to provide fellow investors with honest and balanced views on stocks. With that in mind, let's jump straight into the 7-point review process, starting with what do they do? They're located in Florida and have presence in 13 countries around the world. They were formed in 2011, they have 32 employees, they offer a range of products and services, mainly focusing around blockchain, telecoms and fintech. The current star of the show is Etelix, which contributed $14 million revenue to the group last year. They have other pretty cool concepts such as its B-Chain, allowing consumers and carriers the ability to transfer retail users across mobile networks instantly. For me, the most exciting part of their lineup is the EV battery development that is currently underway. It's in the development stage, but something definitely to keep an eye on. You may have seen that they recently won an Internet of Things Breakthrough Award for 2021. That award was won for Liquid Fuel Internet of Things, which essentially allows domestic users a hassle-free mechanism to making sure that their home fuel is constantly refueled. They also offer financial services, so prepaid cards, which allows their users a cost-effective mechanism to transfer money cross-border as long as you've got the app downloaded on your phone. At the point of recording this, their share price was $1.44 with a market cap of $122.85 million. Revenue for the year ended 2020 was $44.8 million, giving them a revenue to market cap ratio of only 2.7, which when you compare to some companies is extremely low. Now we're going to move on to the financials so we can get a bit more of a flavour of how they're doing. So here we are on their website, and as you can see here, revenue ended 2019 was $18 million, and then revenue, which says preliminary for 2020, but I think there's a high level of confidence around that, ending 44.8. And then moving forwards to the end of 2021, they will expect to have achieved $60.5 million. In terms of growth, this is excellent, kind of moving through the gears each year. So there's a lot going on in this company and one to keep an eye on for sure. But just to be sure, let's go and check out their SEC filings and make sure the latest data they have submitted aligns with everything that's been shown on this website. So with everything going on with COVID, it's always good to look at assets versus liabilities, just to make sure that the company is taking sensible steps to protect the future of their business, and ultimately your cash and your hard-earned money. What we can see here is total assets decreased slightly, from 5.6 million down to 5.3, which in itself isn't a massive deal. But critically, and what impresses me the most, is their current liabilities have gone from 11.3 million down here to 8.3, so they've reduced that by $3 million, which is a really positive step forwards. And the reason why it's so positive is because of the scenario they would have found themselves in. COVID hasn't been easy for many businesses, so to come out on the other side with less liabilities is a fantastic effort from the company. One further thing that really caught my eye that was flagged to me was that the company had eliminated all debt in form of notes, therefore becoming a debt-free company. Dated 17th of February 2021, it reads, "With the exception of routine operational payables, the company is now completely debt-free, with no convertible notes, warrants, promissory notes or settlement agreements." This says to me that the business is really moving forwards and it's actually in a very strong position. And whilst we're talking debt, let's just make it clear that debt isn't actually a bad thing. It's companies that misuse it that's the bad thing, and these guys are using it properly and using it effectively to grow. We'll jump back over to the SEC filings now. One of the things that stands out that makes me think that this is a good company to hold for the future. So here we are on the SEC filings, and this is something you should all be looking out for when investing in companies. This sentence here, so it reads, "To mitigate future dilution over the next 3 years, the company is alternatively pursuing Reg A registered fundraising strategy to avoid the potential need of requiring convertible notes or other forms of toxic financing." So they're really trying to be sensible here and take a strategic approach to financing and not just diluting shareholders. And rather than just taking this report, I've done a little bit more digging as well to see how they really feel about shareholders, trying to understand where their kind of heads are at. And I was able to find this report from last year. So March 4th, 2020. And this press release, coupled with the previous SEC statement that I've just shown you, makes me think that they really care about their shareholders. And further to that, there's some nuggets of information in here which shows you what they think the company is worth internally. So when Mr. Oscar Brito, CFO of Metrospaces, resigned from the board of directors, the agreement was that 5.1 million shares would be returned, and Metrospaces would keep 992 shares, effectively under a lock-up agreement. And it's this next bit that's the real key point that you should be aware of. So additionally, Metrospaces will have the right to purchase up to 1.25 million shares over the next 24 months at $2 per share. So they clearly think that this company is going places. This would have been done when the share price was around 50 cents, something like that. So they were highly confident there was a lot of growth to be had in this company. Further to that, it also says with our goal of an uplist to a national market such as NASDAQ. So from March 2020, we can see where their aim is. They want to get onto the NASDAQ. So just to round off the finances section, we can see some real key data here in the SEC filing. For the 9 months ended September 30th, 2020, the revenue was 29.4 million, a massive leap from 12 months before where it was only 12.5 million. But just so we make sure we're keeping everything balanced here, the operating loss did increase by $2 million, which, to be honest, isn't unusual in growth-focused companies. And the really positive thing here for you as a shareholder is that earnings per share improved drastically. So it was minus 33 cents, increasing to minus 7 cents. I'll make sure I put a link to the SEC filings in the comments section of this video, so you can go and check them out in a little bit more detail in your own time. But overall, to wrap it up in the finances section, I've been through everything in here, and the story looks really positive. A growth-focused company moving in the right direction, and they care about your money as shareholders. So moving on from the financials, we're going to look at the share structure. So here we are on Simply Wall Street. The good news is there's been no insider selling, but I'm surprised to see no shares bought. They have a strong projection for growth, and I expected to see some buys here from insiders. If I scroll down and we see the ownership breakdown, there's 2.6% institutional investment, which is really good. And this is really good because they would have had to meet some strict checks and balances to gain institutional investment. Also, I believe that when you have at least one institutional investor, it's easier to get the next one. Someone's already taken the leap before you, and therefore they can trust that. They have previously diluted shareholders, but I think the business is in a much better place now. All in all, this is kind of what you'd hope and expect to see in a small company that's got a target of growth. Venture capitalist investment, share dilution that's already happened, and the third and final point is when Mr. Oscar Brito left the company, they locked up his shares. And that's really it for the share structures. So we'll move on now to the bull case. What's going to propel this company forward? What's going to make their share price go up and up and up? What's going to return value to you as the investor? So the first thing I noticed when I went on the website that really stood out to me was some of the big names on their customer list. They're on the radar of some absolutely huge organisations. And what this means to me is if they impress just one of these companies and secure one big contract, it would move them forward significantly. Like with venture capitalists, once you get one big contract, the rest will tend to follow because people will talk and people will see that you can deliver. And often the hardest thing for a small business making the breakthrough is getting their foot in the door of somewhere big, because a lot of companies will just go, well, who else do you work with? And if you can't show that you work with anyone big or in their league, they may disregard you out of sheer arrogance sometimes. So the second point on the bull case for me is the regions that they're targeting. They're targeting some high growth areas of the world, and I believe that's shown in their year-on-year revenues. So targeting Latin America and Asia for the 4G and 5G networks. Not only are these high growth regions, but also some high growth technology areas as well. So they go hand in hand, and that's really nice to see. Third point is that they're financially responsible, and that is so good to see. As an investor, you want to make sure that the company that you're invested in is sensible with your money. It's also really good to see that they do not want to dilute shareholders any further. So I feel that if you bought into this company today, you'd be getting value for money and you're buying what you're seeing. There's nothing worse than buying into a company and then the goalposts get moved 2 weeks later. And then you think, I wish I'd waited 2 weeks, and you're already quite sour with your investment. The fourth point on the bull case that I want to focus on is diversity and growth. Now, many small companies will fail over and over and over again to diversify correctly. But I believe iQSTEL are using their existing knowledge and skills, capabilities to roll out into other sectors. They're not trying to reinvent the wheel. They're just upselling what they've already done and already done well. So the final point in the bull case is they're in some highly attractive fields here. And even if they just get one right, it's really going to propel them to the next level. Blockchain, well, it's become pretty clear to me that blockchain is going to have a pretty big part to play in the future. I can personally see it being highly impactful in the live data reporting sector. So when you think EVs, batteries, software, all that big data, companies are going to want that and they're going to need it, and they're going to need it real time. So there's a good opportunity here on that front. And blockchain will help that because it will give 100% accurate data that is untampered with. However, for those of you that have subscribed so far, you will appreciate that it's important to balance everything out. And we can't just look at bull cases all the time because it doesn't give a fair and true reflection of a company that you may end up investing in. So in terms of a bear case, I think that the first thing to mention is that diversity also needs to feature here. And it's just a point to keep an eye on. Just make sure that they're using debt effectively, and for the future, that any strategic moves that they do make Make sure that you agree with it. If I was to be extremely critical, I'd say it was a lot to manage 7 operating subsidiaries in 13 countries with only 32 employees. However, that said, I can definitely see a roadmap with the company that allows them to grow their business alongside any needs and obligations of their customers. The second point is that even with those big names on their customer list, their revenue is still proportionately low. When you think Verizon, Movistar, T-Mobile, Vodafone, Tata, Orange, they're all huge multinationals. So it isn't really so much of a bear point, but it's just something to keep an eye on. And if growth slows down, don't be afraid to ask yourself why. For the third point on the bear case, we'll hop back over now to the SEC filings, which we can see here lists out a going concern. Now this may have changed recently with paying off all the debt, but it says here the company does not have significant cash, nor does it have an established source of revenue sufficient to cover its operating costs. Now my personal view here is that things have changed since this was released. So it was released September 30, 2020. They've just paid off $3.3 million worth of debt. So again, look, this may not be something to worry about right now, but just keep an eye on it in the next filings. So the fourth point to mention on the bear case is the short interest. We can see here that it's increased by 135%. Now we know shorts aren't always right, look at GameStop. But if you are an active investor and you do like to keep an eye on what's going on, this can be quite a good source of information to understand exactly where the company's heading. But as you can see from the past, there's been some very, very high short interest previously. And actually, in terms of total short interest, it's relatively low. So all in all, the bear case was pretty hard to make. I'm impressed with the company, impressed with what they do. I like the look of it, and I think there's definitely room to run. So we'll look now at a little bit of technical analysis just to understand what might happen with the share price in the near future. So for anyone new to the channel, I'll take you through how I've set this up. Down the bottom we have the MACD, then we have the awesome oscillator here, then we have the EMA 200 line and the EMA 50 line. EMA standing for exponential moving average, which basically tracks the momentum in the share price. And the 200 day is a lot slower to track than the 50. But I find the 200 gives you a good trend analysis for longer term investments. So first of all, I've inserted 3 support and resistance lines. So we'll take you through it starting from left moving to the right. So back over here there was resistance around the 25 cents level. So what happened was it hit this roof and then came back down, and then through time it went back up to the 25 cents mark, but then cracked it and moved on. And that was quite a big movement at the time in terms of percentages. Went from 25 cents, up to around the 40 cents mark, which then it suffered again and hit some resistance. Now it hit resistance here, here and here, went through briefly but came back down, hit again, but then followed a similar path as over here where it dipped away and then slowly started to come back up. It tested it again, dipped away and then tested it, but this time critically it went through. However, it wasn't able to sustain the levels and then fell back below. And on several occasions it tested this kind of 40 cents line. 1, 2, 3, 4, 5, 6, 7, 8. And the 9th or 10th time it cracked through. And from here, actually it's made very, very good progress here and kept moving. And then the next level of resistance is around the 74 cents mark. Now it hit it again, and then went through. And actually it had a very, very nice rise here. And it went up to $1.10. Then a big sell-off. Now you're going to see this. I think the problem is with penny shares is that a lot of people have a lot of shares, and down here accumulating kind of a few 100,000 is relatively easy. When you get up here, a lot of people, that 100,000 shares is now worth $100,000. So look, there's nothing wrong with banking profit and taking money. That's what the name of the game is. So after reaching the high of $1.10, it came back down and it went in and around this support line that was previously there. Now it did crack it a few times, but it bounced back relatively quickly. And then it tracked along it 7 or 8 times here, and then bang, it's taken off again. And I believe the majority of this is linked to the fact that they've now become debt free. So a lot of these bars here are kind of people on the first mover side. So you'll have got people who are subscribed to any notifications from the company. They'll have jumped in straight away. And there was a bit of a sell-off, but I remember kind of seeing that on the day, and it was a fairly quick swing, and it ended up nicely for the day. And from there it's kind of built on and built on and built on. And now it looks like we're in an area of consolidation. So trading sideways, I think, when you've hit these higher highs is really, really positive. So the best case in terms of the technical analysis that I've been able to conduct is that it will continue to kind of track in this region here. So anywhere in the kind of 155, 158 zone is really positive. I do, however, think we will see some level of profit taking again. So you may see some big bars here. So I think the thing to notice is that when you have seen big bars, it has bounced back and it is moving in the right direction. So once the profit taking has occurred, I do believe that we will see a consolidation again and a continued rise. And based on what I can see with the company, I think it will probably rise into the kind of range of 4 to 6 times revenue. So natural growth taking it to around $2.88. And I don't think that's unreasonable, especially not if quarterly results go well. And if the financial reports from the company are very positive, then maybe you should start thinking about basing your share price estimations on the projections of the company rather than what they've actually delivered in the past. Because once they've shown they can deliver on their projections, that's when you'll start to get a hybrid between actuals and expected earnings. One final point to note on their future share price is that $2.88 is only 12 cents away from being able to list on the Nasdaq. So the requirement for the Nasdaq is $3. So don't be surprised if you see a real hard push from this company, upping their revenues and trying to push the share price higher. So this brings me on now to the final point. What am I going to do with this company? In order to give a fair assessment, let's go over now to the tracker and see how I've graded it. So here we are on the tracker. I've updated it for all the past picks as well for the end of the week, but I've added them to line 6 here. So we can see iQSTEL, IQST, the ticker, the exchange that they're on is the OTC, the date it was added, which is the 22nd. The price at the point of review is $1.44. So let's start with the financials. It'd be easy to think here because they've paid all their debt off, they're absolutely brilliant, and it's an easy 5. Well, it's not the case. So there is still work to be done here. It's a growing company, and that's going to involve risk. And look, if you trust in the people behind the product, then actually risk isn't a bad thing because calculated risk is how you get that reward. I do think that the diversity at the moment is slightly hurting them. They have 1 or 2 areas of the business that is really profit making for them, and the rest is all development phase. So what I would like to see as an investor, and this is part of the share price that you're getting, is a return on those development stage investments. And unfortunately, we're not going to know how those perform until they've had time to mature them. Overall though, I do think the company is on a positive trajectory. Moving on to growth, I've scored them a 4 because it's really clear to see that the company is growing. They're acquiring businesses, they're setting up new businesses, they've got a targeted approach to growth as well. They've defined their sectors that they want to work in, and I believe they're rolling out transferable skills in different sectors, making the most of their assets. So it's really, really positive to see. Moving on to attractiveness, I've scored them a 4 as well. They're in some really, really interesting sectors. And actually, the operation that's making money right now is one of the least attractive for me. The most attractive element of their business operation for me is what they're looking to do in the EV battery sector. If they can crack that, and they can give their customers real-time, 100% accurate data that's untampered with, they're onto a winner here. And further to that, I also like their blockchain play as well. It's really interesting to see what companies are doing in the blockchain sector. And whilst a lot of the world are still getting their head around what blockchain is and what it can do, I think it's really positive that they're moving now within that market. If we look now at risks, I've scored them quite high here because they are going through a lot of growth, and that does come with inherent risks. As you can see from their financials, they do have a going concern status, and that may be out of date now, but when a company is growing, all it takes is 1 or 2 big mistakes, and it can really hurt years and years of growth. As an investor, I would just urge you to check what their strategic direction is as a business going forwards. Keep up to date with the press releases and make sure that fundamentally you agree with the steps that they are trying to take. Because remember, when you buy a stock, you own part of that company and you want to make sure that it's travelling in the direction that you think it should be travelling in. In terms of the overall rating, I've scored them a 4. I'm impressed with them. I think they're playing in nice areas. They've taken positive steps as well to reduce their debt. They want to protect their shareholders. And if they can nail their blockchain tech or EV battery tech, I think it will really take the company to the next level. And not to mention they're already a known entity to companies like Verizon, Vodafone, T-Mobile and Orange. And with all that in play, there's got to be a lot of potential upside for this company. So what am I going to be doing? Well, I've previously owned shares in this company. I bought around the $1 mark and I sold around $1.20. So 20% increase. I am, however, now going to watch because I do think there may be a little bit of a drop off with some profit taking, but I would certainly at the right price be willing to re-enter this stock and invest again for the future. I do see a strong upside on this stock, and I think it's one to keep an eye on because it could easily take off. I've seen a few YouTubers using the 10x thing, and no, it's not going to 10x. It's just not that kind of stock at the moment. It's certainly got some good potential, and doubling from where it is really isn't unreasonable, even based on the revenues today and the current market conditions that we're experiencing today. So in terms of the action, I've rated it a buy. And I think even if you buy at $1.44, in my opinion, in the long term, this will go higher than that. Overall, really impressed with the company, impressed with the people that I've looked into, impressed with the products they can deliver, and let's be honest, results speak for themselves. So invest in the data, invest in the trends, and I think with this one, you'll be backing a good horse. So I hope you enjoyed this review of iQSTEL. If you did, hit the like button, subscribe, and I do really appreciate your time watching my videos. I enjoyed reviewing it. It's been a pleasure to present this to you. Take care and see you again next time.